This truly is a global financial crisis.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend.
Barclays that began the steep decline, and in the following 40 minutes of trading, shares in the country's biggest banks were sold down and down again.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
Housing market, a combination of greed and lack of regulation.
RBS lost 40% of its value.
In the fall of 2008, the world stood on the edge of an economic abyss. What began as a modest collapse in the American housing market quickly spiraled into a global financial crisis, affecting millions and reshaping economies across the globe. But the crisis was not just a series of numbers. It was a human story. Families lost their homes, workers lost their jobs, and trust in the financial system was irrevocably shattered. As the wheels of global commerce ground to a halt, people from all walks of life were left to grapple with the fallout. This is the 2008 financial crisis, a story that must not be forgotten.
It's described as nothing short of breathtaking, a points drop never before seen on the US markets. This closing bell might as well have been an alarm, so savage was the selling.
The dot-com crash, which occurred in the year 2000, was triggered by the collapse of technology stocks following the rapid rise of internet-based companies. As investor confidence plummeted, stock markets took a significant hit.
Another one, yeah. Too many in a row.
In response to this economic downturn, the Federal Reserve took action. To stimulate the economy, they lowered interest rates, making borrowing cheaper for consumers and businesses. Just as the economy was beginning to stabilise, the tragic events of September the 11th, 2001 struck the nation.
It's 8:52 here in New York. I'm Bryant Gumbel. We understand that there has been a plane crash on the southern tip of Manhattan. You're looking at the World Trade Center. We understand that a plane has crashed into the World Trade Center. We don't know anything more.
In the wake of the attacks, consumer confidence dipped further, leading to a need for more economic support. To combat this crisis, the Federal Reserve lowered interest rates even further, ultimately reaching record lows. This period of ultra-low rates lasted for several years, aiming to encourage spending and investment. With cheap borrowing costs, many Americans found it affordable to purchase homes. Increased demand for housing led to skyrocketing home prices, and many viewed real estate as a safer investment compared to the volatile stock market. Between 1997 and 2007, house prices rose an eye-watering 241%. During this era, banks were making millions in profits. Interest rates were low, borrowing was widely accessible and seemingly affordable, and house prices were booming. So, what went wrong? Subprime mortgages emerged as a popular product among lenders. These loans were marketed to individuals with poor credit histories, promising ownership to those who might otherwise be denied. Many borrowers were not required to send documentation to show proof of earnings and were lured by adjustable rate mortgages, initially low monthly payments that would later skyrocket. To understand this fully, let me explain exactly what the banks were then doing with these mortgages. Mortgage loans were being given out by the commercial banks and people got homes to live in. Then the commercial banks would sell the mortgage to an investment bank. The investment bank would make their money from the interest payments. But to make these mortgages more profitable, they grouped hundreds and at times thousands of them together and turned them into a security that could be sold and traded. These were called mortgage-backed securities. These securities were arranged into tranches, basically a scaling system, listing the least riskiest, with the lowest returns, consisting of prime mortgages, to higher risk but also higher return securities, consisting of some prime and some subprime mortgages. Then the securities that did not sell were packaged together, rated for risk, and sold and traded to investors. These were called collateralized debt obligations. Now, a lot of these CDOs were filled with B and C rated mortgages and were far riskier investments. The problem was they were being rated AAA by the rating agencies, and so in turn hiding how risky these investments were. The obvious question is why? Firstly, the model they were using to rate the securities incorrectly assumed that the housing crash would not happen everywhere at once. Secondly, the securities could be so complex that the correct level of due diligence was not carried out, in turn missing the underlying risk. And thirdly, the rating agencies were being paid by the investment banks, so if the banks did not get the rating they wanted, they could simply go elsewhere. Basically, the rating agencies were being incentivized to class these securities as AAAs. Something that had started as a simple mortgage loan had turned into a vast and complex banking practice that was heavily entwined within the entire financial system and had hundreds of billions of pounds invested within it. The problem was that all this relied on one thing. As long as our house prices kept going up, this in theory would continue. But that didn't happen. Then the chain reaction began. People started defaulting on their mortgages, and so the banks put their homes into foreclosure. But as this pattern repeated, this triggered house prices to start dropping, and in turn the banks tightened up on their lending. This eventually reached the point where people's homes were worth less than what they borrowed, and because the banks had tightened up on lending, people couldn't refinance. With thousands of homes going into foreclosure, supply hugely outweighed demand. And even when the banks did manage to resell the foreclosed homes, they did it at a huge loss. The securities that the entire system had been betting on became worthless. And what about the workforce? The 2008 financial crisis resulted in 27 million people losing their jobs globally.